Although the rally is stalled this morning, like once we got out of the gate, you can see we've just been kind of spinning our wheels. This is nice. All the niches, right? This is the factors. All of them are in the green. That's pretty good. But you can also see they're not up a lot. There's cautious optimism out there. The question is that misplaced? Under bringing down Quadratic interest rate volatility and inflation hedge ETF portfolio manager Nancy Davis. Nancy, you've seen markets battered around by geopolitical events before. And we just had one guest, we were talking about how the script plays out normally. Like they go down initially, and then at some point, even when they're still ongoing, often the market moves on to something else.
Yeah.
Are you surprised at how intense it's felt in this market the last few weeks?
I mean, we've definitely seen VAR events in the rates market. It really started in the European and UK markets. And I think a lot of investors just don't have safe hands because they're not using long options like we are, and they get stopped out. Anytime you have derivatives have a bad reputation for a good reason because it's leverage. That's why we like using fully funded options so we know our downside and we can weather these storms and hold it out because it's been crazy. The rates market went from we had 62 basis points of cuts priced in
Right.
in 2026. Now we have small, like 4 bips of hikes.
Right.
So the move that we've had just with the rise of oil, even though U.S. is energy independent, and yes, oil is going up and there's a lot of geopolitical risk, but interest rate vol hasn't gone up nearly as much as equity vol, so I think that's a scoop. And then the yield curve is flattened from this move higher in short end yields because of less cuts being priced in, and now we actually have 4 bips of hikes. So go figure. It's crazy town.
Let's go over the VAR for the audience who may not be familiar with the sort of value at risk. You say that's Europe, UK. What does it mean overall, and and why hasn't that happened here yet? Or
Yeah, I think it's really just a question of liquidity. I think a lot of investors just weren't able to trade in the UK and European rate swap market. And so they were coming to the US just for liquidity and a way of taking down risk and stopping their positions. Because anytime you have, remember the UK pension fund had a margin call where they ironically had to go and sell gilts to post collateral against. So there's just so much leverage out there in the system. That's why it's, I think, a lot safer to use fully funded options to get that directional exposure, because then you know your downside risk. And when you have these crazy moves, you can be a long-term investor and say, all right, look, this is crazy, this doesn't make sense, but I can sit and wait it out.
It's like insurance though, right? I mean, you only kind of think about it after the fact. I mean, people don't like to pay insurance, but when you need it, you really need it.
You really need it. And I think it's also like the education that in bond portfolios, the ag index, for instance, about 30% of it is short OTC options because homeowners are long the prepayment risk. You always hear about, oh, it's a prepayment. It means somebody else is long the option, therefore you are shorted in your bond portfolio. And I think that's one thing I'm trying to help educate, and I know you've been great with education of every investor, so you understand that.
Yeah. Well, what I love about our conversations is that you brought it out, particularly with the options aspect of it, that people want to learn this. Like I know for a fact that more and more retail investors are wanting to learn this. And to your point, how to make these rough periods smoother so you can sleep better at night without the sort of doom scrolling or risk or listening to all the talking heads saying it's going to get a lot worse every day.
Yeah, I mean, to keep it real simple for your viewers, when you sell an option, you are short volatility. When you buy an option, you're long volatility. And so when implied vol goes higher, that's a beneficial thing. So it's that simple. It's just understanding what you own.
What do you think about how things are shaking out? I mean, listen, I know that now the pendulum has swung to no rate cuts, technically maybe a rate hike, but if this settles down quickly, and I think it will, do you think the Fed comes back in the picture?
Yeah, I think the yield curve will steepen as those expectations for cuts come into play. Because, when we get our new Kevin Warsh steps into the shoes, I think he's going to get fired immediately if he hikes rates, don't you?
I wouldn't want to be him. I don't think he's going to hike him for sure. Whatever else he can do besides
that's what's expected right now, and it doesn't make a ton of sense to me.
That we're looking at anyone's modeling rate hikes. No one's taking that serious. I mean, Christopher Waller said he was almost a dissent the last time, and we know, of course, Myron is a dissent. We'll hear something from the Supreme Court any day with respect to Lisa Cook rather. It just, to your point, I still think the Fed will be as accommodative as possible, and that means at least some sort of a cut before the year's over, maybe two.
Yeah, and that would be amazing. We would love that. That would steepen up the yield curve and strap yourself in and feel the G's.
Okay. Nancy,
All right.
love seeing you.
Great to see you.
It's springtime. You have no excuse.
No excuse.
All right. See you soon.